All right, we are back for a mobile edition. I am in the car. I'm out in the field for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
Ty, I think this is just so amazing that this activity you and I do is so important that you're willing to do it from the car. So shout out to you, shout out to the entire community. Thank you so much.
I love it. So this is for, I can't believe it's the first week of June, June the 2nd, 2023. Let's get right into it. So what a wild ride. Interest rates. What did you see this week? Your thoughts about the 30-year mortgage this week?
Yeah. So first and foremost, the fact that we have receipts and people can go back and look at our conversation from last week. I'll remind you what we said and we'll remind you of what actually happened. So last week, everybody was freaking out. Mortgage rates are over 7%. They peaked at 7.12 based on the numbers that I've seen. We told the people this was coming. We were talking about a debt ceiling. It was a very, very unlikely but non-zero event. We had the Fed talking tough. We had all of these activities. And of course, the bond market would act, rates, mortgage would go up. And of course, they did exactly what we said they would do. The good news is last week we told you over the next 2 or 3 weeks, we're going to have a series of things and rates would start to grind lower. Number one, debt ceiling deal. We got news over the weekend that it would happen. It passed the House and then it passed the Senate. We're done. Rates are already down to 6.85. So they've already come down 25 basis points in like 2 or 3 business days. We have an ADP, or we have job reports that are strong, but we have a CPI report on the 13th. I believe is going to surprise people shockingly low. Yeah. Also, yesterday, or what would have been Wednesday, the market, the smart money, was betting 67% that the Fed would raise. I came out in the daily financial news and said, I'm not changing my opinion. I know the market says I'm an idiot. I'm not changing my opinion. Lo and behold, the next day, 2 Fed presidents came out and said, we're going to basically pause. Suddenly, the market went from 67% chance raise to 27. So again, as I expected, as I told you was coming, we're not going to get a raise on the 14th. In fact, I think we pause all year. We'll see what happens. But all of these things lead to me from peak fear and uncertainty to rates grinding lower. I still think we see rates sub 6 by the end of the year. And if the economic data is bad enough, we might see sub 6 by the end of August. So that's where we are. That's where we're going. I'm glad we warned people. I'm glad rates are already falling.
I love it. And 100%, you've been calling it. I've been following your lead. We talked about it last week and really that just a lot of political posturing. They obviously got it all worked out over the weekend. And so it seems as though we're back to business as usual and probably back on track to things you've talked about over the last 3 to 6 months. Would you agree?
Absolutely. Totally agree. We, the debt limit was always kabuki theater. It's now, hopefully behind us. And, we'll talk about it again in 2 years because it'll come back in 2 years.
Very interesting. Well, let's keep moving. Let's talk about the JOLTS report. Maybe explain too, what is the JOLTS report and what happened this week?
Yeah. So the JOLTS report is a very interesting monthly report that talks about job openings, quits, wages, things of that nature. What was most opening for me is job openings. For the last 3 or 4 months, we've seen job openings fall. And again, let's be clear, that's the Fed likes that. For a long time, Ty, we had 2 job openings or almost 2 job openings for every unemployed person. That's not a healthy job market, or it's extremely healthy depending on how you look at it. Then we had job openings fall. They fell as low as 9.7 million. The expectation is they would fall to 9.4 million. They actually came in at 10.1 million. Job openings increase. I actually think what we're going through is something we talked about 6 months ago, is our economy is changing. What we are seeing is the high end, the top 10%, the white collars get whacked at Amazon and Meta and all of that, where the bottom 90% are having more job opportunities and higher wages. The JOLTS report talked about the average yearly wage increase at 6.7%. So some of us are scratching our head going, how's the economy strong? Why is Vegas packed? Why is everybody getting on airplanes? It's because the 90% are doing better. Yeah, the 10%, the white collar, the discretionary spenders, they're pulling back. But the 90%, they're doing better. That's what I think's happening.
Very interesting. And again, you talked about it. You said this, again, talking about keeping receipts. You were talking about a white collar recession last year. You were talking about, this has been a very consistent theme for you, saying, hey, the middle probably actually does a little better, but the white collar, it's going to be a white collar recession. And you said it would be in these small tranches and waves, which it has. It feels like we're just dragging this thing out. It feels slow. And at times, I'm sure for some people, it's painful. Let's continue. Let's talk about ADP, the ADP payroll. What happened this week?
Yeah. So one of the things, right? JOLTS reports is interesting. Job openings is interesting, but that's not a job, right? That's not a hire. That's business interest. The ADP report is a private payroll report that says how many jobs were created in our economy. So again, the expectation was 180,000. It has been going down month on month. But what happened this one is it exceeded. I think it came in at like 237, or it was a significant beat. It might have been 287, actually. So again, that's not good news for the Fed. But again, if you look inside the internals, that's why the internals matter. So 287,000 jobs created. Ty, 205,000 were leisure and hospitality. Not necessarily the highest paying jobs in America. Where did we lose jobs? 46,000 in financial services, 49,000 in this other area. So again, we are seeing more jobs, but they're not the high paying jobs. I think the economy is broadening out. I think more people are getting wages. And again, wages are going up for the bottom 90%, and that's okay.
Very interesting times. Again, something you've talked about. Very interesting times. It's interesting too. And I go back to this about the whole, you did that 50-year report about, and I bring it up about every 2 or 3 weeks, but it just feels like we're in that same pattern of history repeating itself, another cycle like the 80s. Interest rates going crazy, lots of fear and uncertainty, but yet with the wage inflation, you see growth, and you do see things improving for some.
Oh, absolutely. Yeah, it's really funny that people just want to fight it instead of look at the data. Yeah, I know today's different and all of that, but there's a hidden gold in looking at the period from 81 to 86. It won't all be the same, but it is wild. How could I call a transaction crash when everybody was talking prices? Because I saw what happened last time. And I called the number 40%. This is not, I don't have a crystal ball. I look at history. Oh, wild.
Spot on. And again, folks, I would say go find that video that Michael, it's a very well-researched, and honestly, I don't think it's talked about enough, but that where you go back and look at the 80s, what is the name? Do you remember the title offhand?
Well, you can look up 52-year spreadsheet. You'll probably see a dozen videos on it. 52-year spreadsheet.
Okay, there you go, folks. If you are really into this and looking at the cycle repeating itself, take a look at that. Let's continue. I want to finish and talk about housing. I want to talk about housing inventory, but also, and then let's finish on a high note, opportunity, which is what this channel's all about, what you teach in your course, what you're all about in the One Rental at a Time community. What did you see with housing inventory this week?
Yeah, I think there's something going on in the housing market. Again, last week we breached 7%. 7% has been the number that really slashes demand. So I expect housing inventory to go up a little bit. They went up 8,000 last week. Shout out Logan from Housing Wire. Every Sunday night he reports on the Housing Wire. Great follow on Twitter. I actually think what's going on with inventory rising is actually something below that. Days on market are exploding. We're not seeing new inventory. Inventory is still down 20%, but at 7%, you get less transactions, which naturally means inventory goes up. But what we should all expect is days on market in May, which is the month we just left, to explode higher. So it's just slowing down. And then finally, to close on opportunity, I think we've seen peak rates. I think rates will come down. We saw an article, I don't know if you saw this, by Redfin, talking about 48% of investors have left the market. It's really the big boys. what you saw in the article, if you got away from the scary headlines, is the mom and pop investors, the one rental at a time family. We are doing great deals on entry level homes. We are only buying positive cash flow. And again, 48% down. The whole market's down 41%. It's always funny how these doomers don't tell the full story. Plenty of opportunity. It is never easy, but if you do the work, you have a chance. If you take a shot, you have a chance. If you sit on your ass scared because the doomers are in your head, you're not going to do anything. So don't be a doomer. Do the work.
Do the work. I love the theme, and I couldn't agree with you more about opportunity. There's always the opportunity, and of course, what you've been talking about the whole time is doing the work. Let me just throw an idea and a thought at you, or really a thought. Your opinion on, we probably finished the year out at about 4 million transactions. Is that plus or minus?
Yeah, I'd say plus or minus 10%. I would actually say the low is going to be 4. I would go 4 to 4.4. So we're right in there. Transactions.
Do you see inventory normalizing? I know most markets, especially below the median, we're running 2 weeks supply, less than 30-day supply. I believe a normal market would be probably about a 90-day supply. Anything above, if you went to a 6 months of inventory, standing active inventory in an MSA, they would call that a buyer's market. Not trying to define the market by words or buyer or seller market, but do you see inventory staying low through the end of the year into next year?
Yes. And if you hear that, you should realize that's an opportunity. Shop for off-market deals, shop for the ugly ducklings. There are people that want to buy homes but can't finance junk. So if you can find junk, you can put a deal together. There's plenty of opportunity there. It's never easy. It's hard today, but there is plenty of opportunity if your ARV is below the median price. I have multiple millionaires coming on my channel every week, killing it. Jason Pritchard made $300,000 in a month, filling the need. The need is properties below the median. Don't be an idiot. Fill the need.
I love it. I love it. Well, folks, you heard it here. Thank you, Michael, for all that you do. Folks, if you have any interest, and I would say, why would you not? If you are not a part of the One Rental at a Time community, if you have not bought this man's course, again, I keep saying this, we are going to twist his arm. He will be raising the prices on it at some point. It's $399. Is that correct?
Correct.
And they can find it where, Michael?
OneRentalAtAtime.com. If you're on my channel, you'll see a link below.
I love it. Michael, thank you for all that you do. Have a great weekend.
Take care, man.